Hey everyone, and welcome to this explainer. Today we're going to systematically unpack SA 265, breaking down exactly how auditors handle internal control deficiencies. So whether you're gearing up for your ICAI exams or you just want a better grip on the rigorous standards that keep our financial systems honest, you are absolutely in the right place. We're going to take these complex audit standards and turn them into a totally clear, logical roadmap. Let's get right into it.
Okay, let's kick things off with a pretty critical question. What actually happens when an auditor finds a crack in a company's financial plumbing? I mean, do they run straight to the CEO? Do they blast out a public report? Or, do they just make a quiet little note in their files and move on? Understanding exactly who gets told what and when they get told is literally the heartbeat of Standard on Auditing 265.
And to answer that, here is our game plan for today. We'll follow the audit journey step by step. Number 1, defining internal control deficiencies. Number 2, spotting and evaluating weaknesses. 3, the auditor's core responsibilities. 4, communicating and documenting findings. And finally, number 5, we'll wrap up with the SA 265 memory trick.
All right, Section 1, defining internal control deficiencies. Let's see how this builds our understanding of a company's financial foundation.
Before we can even talk about a deficiency, we really have to understand what it is we're measuring, right? Think of internal control as the essential processes that are designed, implemented, and maintained by management and those charged with governance, which we usually just call TCWG. These controls are put in place to give reasonable assurance of 4 really critical things: the reliability of financial reporting, the effectiveness and efficiency of operations, compliance with laws, and safeguarding the assets. Honestly, they're basically the guardrails keeping the company on the road.
Now, what's super interesting here is how a deficiency actually happens. It's not just about a control being totally absent. According to SAD 265, a deficiency crops up in one of 3 very specific scenarios. First, a control is just completely missing, gone. Second, it's there but it's poorly designed, like fundamentally flawed from the start. Or third, it looks amazing on paper, but it's just not operating effectively in the real world. As an auditor, you are constantly on the lookout for all 3 of these failure points.
Moving on to Section 2, spotting and evaluating weaknesses. Now that we know what a deficiency actually looks like, let's talk about how auditors spot and judge them out in the wild.
Look at the stark contrast between the 2 types of deficiencies you're going to encounter. On one hand, you've got an ordinary deficiency. This is a weakness that, frankly, just isn't severe enough to bother the top brass with. A classic example? A minor delay in recording petty cash vouchers. It's a hiccup, no big deal. But on the flip side, we have a significant deficiency. This is a massive red flag. It demands the immediate attention of TCWG. Imagine a situation where there's 0 segregation of duties, like one single employee is receiving, recording, and depositing all the cash entirely by themselves. No way. That is an absolute recipe for disaster and fraud.
But how do you, as an auditor, objectively decide if a weakness crosses that line from just ordinary to truly significant? Well, you've got to evaluate these 5 crucial factors. You have to ask yourself, what is the likelihood that this flaw will result in a material misstatement? What's the magnitude or the possible financial impact? What is the exact nature of the account affected? How frequently is this error popping up? And finally, what's the root cause of the deficiency? Weighing these factors really helps you grasp the true risk posing a threat to the financial statements.
All right, Section 3, the auditor's core responsibilities. We know how to spot and evaluate the cracks. So what is the auditor actually mandated to do about them?
This right here is absolutely crucial. You really need to master this high-scoring 4-step rule, especially if you're prepping for your ICAI exams. Step 1, you identify the deficiencies during your routine audit procedures. Things like tests of controls, observation, or inspection. Step 2, you evaluate whether they're actually significant, using those 5 factors we just covered. Step 3, you communicate those findings to TCWG and management appropriately. And Step 4, you must thoroughly document everything: the deficiencies, your evaluation, the communication, and your final conclusions. It's a very strict, highly logical sequence.
However, and this is a really vital caveat, remember the limitation of an auditor's responsibility. The auditor is not required to identify every single deficiency in internal control. You are not expected to be some kind of omniscient defect hunter. The audit is designed to express an opinion on the financial statements as a whole, not to give a comprehensive health check of every internal system. So you're only obligated to report the flaws you actually stumble upon during your specific, scoped audit procedures.
Which brings us to Section 4, communicating and documenting findings. Let's figure out exactly who gets told what and when this communication actually needs to happen.
Comparing these two groups clears everything right up. Management is in the weeds. They're involved in the day-to-day, so they get informed of appropriate ordinary deficiencies and your suggested corrective actions. Because these are lower stakes, informing management can sometimes just be done orally. On the other side, those charged with governance, the overseers, they have to be informed of the significant deficiencies. And because of the severe risk involved here, communication to TCWG absolutely must be a formal written report. Plus, it generally needs to happen on a timely basis, ideally way before the auditor's final report is even issued.
Now, when you're drafting that crucial written communication to TCWG, you can't just write, "Hey, things look bad." SA 265 mandates very specific contents. You need to make sure it includes a clear description of the flaw, a detailed explanation of the potential financial effects, and your professional recommendations for improvement. Maybe that's better IT security or employee training. You also need a very clear disclaimer stating that the audit was not designed to identify all deficiencies. And finally, you must state the intended use of the communication, just to make sure it isn't taken out of context by any third parties.
Here is a quick warning for all you students out there. Make sure you don't confuse your standards on exam day. SA 260 and SA 265 both deal with communication, but they are incredibly different. SA 260 has a much wider scope. It covers general audit matters, overall findings, and auditor independence. SA 265, which we are laser-focused on today, is highly specific. It covers only and solely weaknesses in internal controls. Make sure you keep those distinct in your mind.
And that brings us to Section 5, the SA 265 memory trick. Let's transition to our final section, where I'm going to give you the ultimate tool to lock all this information into your brain so you have total retention on test day.
Literally just memorize the word control to absolutely ace your test. Here is how it breaks down. C stands for check internal controls. O is for observe deficiencies. N is notify management of appropriate issues. T is tell TCWG specifically about significant deficiencies in writing. R means recommend improvements to fix the systems. O reminds you that only identified deficiencies are reported because of your limited responsibility. And finally, L is for log, meaning thoroughly document all communications and conclusions. If you can just write the word control on your scratch paper, you've got the entire standard mapped out. It's a total game changer.
Take a mental snapshot of this quick revision table. It perfectly summarizes the whole shebang we've unpacked today. The objective? Clear. Communicate the deficiencies. TCWG? They get the significant ones, always in writing. Management? They get the appropriate ones, and oral is fine. The timing? Has to be timely, generally before the final report. And documentation covers the deficiencies, the evaluation, and the communication itself. This right here is your ultimate cheat sheet for SA 265.
So we'll wrap up with this final thought. Since we've learned today that auditors are strictly limited to reporting only what they stumble upon during their specific procedures, ask yourself this. If an auditor misses a cleverly hidden defect, whose ultimate responsibility is it to fix the system before it completely collapses? Well, remember our definition of internal controls. They are designed, implemented, and maintained by management and TCWG. The auditor is just there to test, not to build. The ultimate responsibility for a watertight system always remains with the company itself. Thank you so much for joining me for this explainer, and I really hope this makes navigating SA 265 a whole lot clearer for your studies and your professional practice.